Well, hey there, everyone. Welcome to Chart This with Dave Keller. It's Friday, July 17th. My name is Dave Keller with Market Misbehavior, coming to you live from Southwest New Hampshire. We're up here for a weekend of board meetings at the Walden School. It's a music school based in New Hampshire, where I'm on the board. Looking forward to reconnecting with my music colleagues up here and fellow board members and the faculties and staff of this fantastic place, the Walden School. Thought I would take a quick break, though, from preparations for the weekend and review some of the charts that I have that stand out here midday on Friday. We're recording this just after lunchtime on Friday the 17th. And also, I've hand-selected 6 questions that have come from viewers like you during our live stream, but also during people posting questions on our YouTube channel. As always, if you tune into this show live, and sorry we couldn't do a live broadcast today, but we'll be back on Monday with our next live episode. All during the live streams, you are welcome to ask questions all along the way. We'll take any that we don't get to and put them in the mailbag. You can always drop questions on our YouTube channel. Got a lot of thoughts to share with you. 2 things before we get started here. Well, actually, a couple things. But first off, nice recovery day. And I would say, this bounce that we're seeing in charts like Micron, pretty encouraging, right? I mean, if you look at what happened, first thing this morning, I'm writing a note for my premium members and saying, look, everything's opening lower. Technology's at the bottom of the leaderboard again. Unless we see some big rally today, things are looking very vulnerable going into a heavy earnings week last week. I would say a very encouraging sign, at least midday here, is this nice recovery. We're seeing a lot of bullish engulfing patterns on charts like Micron, names we highlighted on Wednesday and Thursday's show as breaking down through the 50-day moving average. What I always say is when you have a breakdown like that, you look for signs of accumulation. You look for signs that buyers are starting to come in. I'm less of a fan of buying weakness, right? Buying when things are just going down, because for me, that tells us there's distribution. I want to buy on strength off of the lows. I want to buy when there are signs that there's accumulation. And again, the market's not closed yet, so we've got a couple more hours to digest and anything can happen. But if we would close around these levels on a stock like Micron, that suggests actually a pretty encouraging setup going into next week, at least as a short-term bounce, right? And I don't think it changed the entire trend that we've observed over the last couple of weeks, but certainly implies that at least we get a brief pause that refreshes and most likely some sort of tradable bounce next week. We'll have to keep an eye on that chart, of course, as well. And by the way, one of the other charts I want to highlight for you is this one, because we just dropped a video on our YouTube channel yesterday doing the Choose Your Own Adventure style video, talking about 4 different potential scenarios, something we like to do pretty regularly. Take a chart like the S&P or the NASDAQ, lay out 4 different scenarios from the super bullish to the super bearish, talk about all the different things that could happen to make each of those different scenarios play out. And then after watching the video, you vote which one you see as the most likely over the next 6 to 8 weeks. Then after you vote, you can read some of the other comments. And I've found it is a great way of taking the blinders off, making sure that you force yourself to get outside of your biases and think about some different potential moves and some different opportunities. So if we prepare more today and think about different probabilities today, I think you'll be better prepared for whatever happens tomorrow. So you can find that video on our YouTube channel. I would encourage you to check it out, watch the video, vote, and then check out some of the other votes that people have thrown in there. So midday, obviously, and we can't do a full update because the markets are still open, but, the NASDAQ was down over 2% at the open. It's recovered a bit. And still down, 0.75%. But, we've had a nice recovery through the course of the day. And again, charts like Micron having that nice bounce, pretty powerful. The VIX did spike up to 19.5 right after the open today. It's currently just below 18. So we had an initial spike in vol, all kind of coming down a little bit. And again, we'll have to see what happens going into the close. Rates are generally moving a little bit lower. The dollar's popping a little bit higher. Precious metals actually recovering pretty nicely. Crude oil prices, of course, one of the clear winners today as events in the Middle East sort of imply further disruption to the global supply of crude oil. So both the crude benchmarks up over 4% today. Cryptocurrency is kind of mixed, but you're seeing a nice rally in Bitcoin as equities have rallied. Technology, again, first thing this morning, technology was down at the bottom, and it's sort of slowly been climbing up higher and higher. So it's looking a lot like some of the days we saw earlier this week. Energy, of course, the big winner with crude oil prices spiking. Generally pretty good for energy stocks. Noting also that both the consumer sectors were down over 1% today here by midday. The breadth is a concern, right? And again, we'll see what happens going into the close, but we're certainly observing midday here some weaker breadth conditions, about a 2-to-1 ratio of decliners versus advancers in those key metrics. We'll have more of an update for our market misbehavior premium members over the weekend. As a reminder, it's always a good time to become a market misbehavior premium member. You can find more info about that at marketmisbehavior.com/premium. 3 great benefits. First off, we'll teach you all about technical analysis and behavioral finance through our virtual courses. So if you like what we do on the show, and you want to learn more about how you can better understand charts on your own, we have virtual courses to teach you, I think, the tools and techniques you need to know. We also have member-only reports like our weekly flight plan. That's our main investment report that goes out every Sunday. That is where I feel like my most important work is done for my premium members. These daily market recaps are sort of additional data points building on what we talked about in that weekly flight plan. Also a monthly chart review where we use our proprietary market trend model on a series of ETFs and asset classes. Also access to our member community, which is a great supportive group of like-minded investors. Again, check it out at marketmisbehavior.com/premium. Would love to have some of you join as premium members this weekend. All right, we'll take some questions here from all of you. And again, thanks so much to those of you tuning in live through the course of this week. As always, just go to our YouTube channel to drop questions. We're always looking for great ones to feature on our next Friday episode. Here's the first one for today. Dave, I'm reading through books on your reading list, and I came across the ADX. That's the Average Directional Movement. Last year, my worst months were late October 2025 to March 2026, when the S&P's ADX was below 20. Very interesting. Thoughts on using the ADX? So a couple things, right? First off, thanks so much for mentioning our reading list. The way you can find that, folks, is if you go to my website, marketmisbehavior.com, click on reading list. I mean, again, if you have not read these 3 books and you are actively investing, I think you are missing some key fundamental like building blocks of the appropriate way to think about the markets. This first book will teach you all about fundamental and technical analysis and how to combine them. The second book will teach you a lot about trading psychology and risk versus reward and the mental game of trading. And then this one will teach you all about the bull and bear cycle, which we've seen so many times. And every bull and bear cycle is a little bit different, but has so many similarities to previous ones. The book I think you're mentioning is this one. Wells Wilder, in this book in the 1970s, was really transformational. The RSI, which is one of the indicators I use heavily every day, was sort of unveiled in that book. Also, the DMI, the Directional Movement Indicator, and its derivative, the ADX. Also others like parabolic studies and things like that. So you check out that reading list if you're looking to build out your library or learn more about technical analysis. Now, let's bring up this chart you're talking about. You said, I'm bringing up the S&P, and you have the ADX line on here. So let's do this. ADX line, we're going to do that. And then down here, I'm going to do the ADX line with the positive and negative directional movement indexes. There we go. So basically, you're talking about this indicator right here, the ADX. And so the ADX line is really derived from a different indicator called the directional movement indicator. Wells Wilder had this concept that, in an uptrend, you want to measure the highs and make sure the highs are getting higher. In a downtrend, you want to measure the lows and see that the lows are getting lower. And that's what really defines an uptrend and downtrend. I'm summarizing big time here for purposes of time. So essentially, the green positive DMI line tracks the highs. The red negative DMI tracks the changes in the lows. If the green is above the red, trend is bullish. If the red is above the green, trend is bearish. That's the way you think about it. The ADX line is really derived from these. So you can see like this period that you're talking about, October 25 to March 2026. That's this period here. We can see that the positive and negative directional movement indexes are popping back and forth between each other. Then all of a sudden, the negative DMI really starts to spread out well over the positive DMI. And then look how the ADX line starts to push higher. Now, this panel here just breaks the ADX line on its own. which is a little easier to see if that's what you're trying to get to. So what you're asking about is a period where the average directional movement was very, very low. So the way to think about the positive and negative DMI, the green and the red lines, is basically that tells you the trend. Green over red, the trend is bullish. Red over green, the trend is bearish. The ADX measures the strength of the trend. If the ADX is low, and I would say generally like below 20, that means there's an absence of directional movement. This is a sideways trend according to the methodology. And so you're looking at a period where there just wasn't a ton of directional movement. When you have big uptrends, the ADX line tends to be pretty high. When you have big downtrends, the ADX line tends to be really high. So a higher ADX is not on its own bullish or bearish. It just tells you whether we're in a trending market or not. So what you're implying to me is when the ADX is very low, that's basically an absence of trend, which means we're more in a consolidation phase. So you're probably, your toolkit is probably more of a trend following or momentum based toolkit. So when the ADX is high, you're probably doing a lot better because there's a clearly defined trend. So what I would say is this is actually the way that Wells Wilder talks, and many others have talked about, building on Wells's work, have talked about using the ADX line, right? If you have a trend following toolkit, look for charts where the ADX is breaking above 20, because that tells you there's an active trend that you could probably follow. If the ADX is low, you probably want to be thinking more about mean reversion. So, when the ADX is below 20, you want to think more like a swing trader. When the ADX is above 20, you want to act more like a trend follower. That's kind of the way to use it. Now, I'm summarizing and generalizing here, but that's why the ADX can be so helpful. Now, do I use the ADX very often? I really don't. And I will tell you why, because I guess, have found, and maybe my process has evolved, that just by looking at the price itself, I can pretty easily tell when we're in a trending environment or not. And I feel like I have a pretty good sense of when I want to be using more of a swing trading, choppy sideways toolkit or more of a trend following momentum toolkit. However, for scanning, that could be really helpful, right? Scan for stocks where the ADX is above 20 or below 20, whatever you're trying to do. So I think for scanning, that's where I found the ADX. If any part of my scan means I want to know if it's in a trend or not in a trend, ADX is the go-to indicator to do that. By the way, on stock charts, one of the contributors, Joe Rabel, uses the ADX line heavily in his work. So I'd encourage you to check out the Stock Charts TV YouTube channel, and particularly look for Joe Rabel's weekly show. He does a great job of featuring lots of examples that use the ADX, and hopefully that helps you out. Next question was KDP, that's Keurig Dr. Pepper, forming a potential head and shoulders, or were the shoulders too different in shape for it to be labeled as such? So what I love about your question right there is, in the question, you're demonstrating some basic understanding of this pattern and things that we've mentioned, right? I always talk about the symmetry, right? That you want sort of a regular shape, because with price patterns, you have to remember there's always like the textbook kind of idealized version of that pattern, but then there's like real life and kind of the imperfect patterns we often have to deal with. So let's look at KDP and see, was that a good example of a head and shoulders pattern? I think you're talking about, I'm guessing you're talking about this. So let's zoom in a little bit here. I'm guessing you're talking about this as a head and shoulders pattern. You might also be talking about, I don't know what else you'd be talking about. So I'm gonna assume you're referring to this pattern up here, right? Which is, here's the head, here's the left shoulder, here's the right shoulder. I don't have a huge problem with that. I mean, if there's any critique of this pattern, I would say it's this. Remember that a head and shoulders pattern, if you read like the Edwards and McGee book, which by the way is also on my recommended reading list. So you'll find it there as well, by Ralph Edwards and John McGee, kind of the Bible of technical analysis, really the best resource out there on price patterns, I would say. If you look at it, a head and shoulders pattern ideally takes like a couple months on a daily chart. It's not like 3 to 4 weeks, which is more what this is. So I would say the only problem I have with this is it's a little shorter term than ideal. However, is it a potential head and shoulders? I would say absolutely. What you want to remember about a head and shoulders top, you have to connect the swing lows. So that means the low between the head and the left shoulder, the head and the right shoulder. Here's a trend line connecting the low. So until and unless we break below that trend line, it's a potential head and shoulders top. It's not a confirmed head and shoulders top. A break below that neckline would confirm the head and shoulders top and indicate further downside. So a couple more comments on this particular pattern. Again, a little shorter term than average, but just using it for example. Number one, remember that also a break below that trend line would also mean a break below the 50-day moving average. So that's another thing that, for me kind of says, uh-oh. The way that you think about a downside objective is basically you take the height of the pattern. So we're going to do this. And then you want to project that from the lows. Whoops. Oh, come on. There we go. So that's the height of the pattern from the top of the head to the neckline. If and when we get a breakdown, that's your minimum downside objective. So the way that you measure this is if we break below the neckline, then the way we identify a minimum downside objective, you take the height of that pattern and you subtract it from the breakdown level. So we haven't broken down yet. So this downside objective is not ready. But if we would break below that blue trend line of support, that would be the minimum downside objective around 2650. That would imply basically a retest of those March, April lows. So that's how I would think of the chart at KDP. Not a horrible example. I've seen worse examples of head and shoulders patterns, but to your point, still a potential head and shoulders pattern until it breaks the neckline. Dave, why do you look at the 9 Morningstar style boxes and not expand it to the wider view with income, etc.? It would be a nice short addition to add some comments on the rest of the market factors. Hey, great feedback. I don't mind your question. I don't mind your suggestion. What you're talking about is, here usually we look at the market factors here, and I like to kind of go through these. And I will tell you this probably, and what you're asking is why don't I do this and look at what they call on stock charts the extended factors. So you're looking at all these other ones. Income isn't one of them, but revenue, momentum, low volatility, and quality are the 4 additional factors that are measured here. And the reason is because there are large, mid, and small cap ETFs that track each of these different quadrants. So each one of these boxes is linked to an ETF that tracks that particular space. So why don't I do that? I mean, honestly, I think this probably comes from years working with portfolio managers that would, just think very closely about their Morningstar style boxes, because they would get assigned to a Morningstar style box. One of the 9, they would, they would have their fund charted and identified in like the, mutual fund publications, kind of showing here's where this fund is. So they thought very heavily about where they were, and they wanted to make sure if they were a large cap value fund, they certainly needed to make sure they were in the large cap value sort of section here, because if not, like you're not really doing your mandate. So the way that they would validate to a potential shareholder, I'm sticking within my mandate. It was all measuring, by measuring their fund and where it was located versus the benchmark. So we'd always show here's where the benchmark scores and here's where the fund scored. So I spent so many years thinking and working with portfolio managers along that. That's just the way that I think about the space. Now, having said that, is there a time to broaden it out and look at some more? So here's like the 9 boxes, and then here's like 12 more, which track these other factors. I don't have a problem with that. And for sure, I'd welcome you to do that. I mean, for me, it's just additional information. You can't look at everything is the problem with this. And this is the problem anytime I get asked about like a particular visualization that I don't use often, it's like a particular indicator. There are hundreds of technical indicators. I can only use a couple consistently. Otherwise, I'm just going to have a bunch of noise, and I need signal, not noise. So for me, that is just the framework with which I think of the equity space. It has served me well. I don't feel like not having those additional columns has caused me to miss anything. Does that mean it's the right thing for you? No. I mean, take a look at that for sure. And I hope that it enhances your understanding of the equity landscape for sure. All right, we'll continue on. I've got 3 more questions to get in with you, but just want to remind you guys, we've got a free webcast coming up next week on Wednesday, July 22nd, 1 p.m. Eastern. We're going to be doing a free webcast called Morning Coffee Routine, Dave's Daily Framework for Market Awareness. There's a set of charts that I review every morning. I really try desperately not to miss that routine, and it literally is my morning coffee routine. I usually get up, shower, do like some stretching, write in a journal, do some prayer, meditation type of thing. I light some incense around that time. And then once I open up my laptop, I go through the morning coffee routine. I'm going to show you, first we'll talk about why routines are so important, how to think about your daily framework, but then I will go through the charts that I review every day and share the insights with all of you. You can sign up for that free event at marketmisbehavior.com/coffee. My goal is to help you develop better routines and techniques to make better decisions in your own portfolio. And I hope you will join me for that free event to help you upgrade your process. All right, next question. Dave, sure looks like an ascending triangle. I think this is on the S&P, yep, with a horizontal line around SPX 75.75 and ascending lows. Boy, I've gotten a lot of, critique's not the right word, but I'm getting healthy pushback on, how I'm thinking about the chart of the S&P. That's fine. What you have to remember with price patterns, there's always so many ways to label something. There's a couple ways you could label this, right? And I would say I started out going with the symmetrical triangle or coil pattern. This is the way that we had generally labeled this pattern. We saw that as a good breakout there. But since then, we really haven't had much of a follow through. So I'm now more in the camp that, all right, this is more of a consolidation phase. I'm kind of thinking of this general level, and I'm kind of thinking of this general level. And I'm just kind of, summarizing here, but just kind of thinking of this as like the highs and the lows. Now, what you're saying is, isn't this just a big ascending triangle? And here's the higher lows. I'm kind of like this. Maybe I would say, but again, whether you call this an ascending triangle like you're proposing, which I get your point, or whether you call it a sort of a sideways consolidation phase, a basing pattern, as I would call it. In either case, a break above 7,600 would resolve that pattern to the upside, right? If it's a basing pattern, break above 7,600 initiates a new breakout. That's bullish. If it's an ascending triangle, a break above 7,600 would be bullish. That'd be the breakout. So we can label it either way you want. The way we think of the lows may be a little bit different. We're in agreement, though, that a break above 7,600 is the key. So I think of in either case, it's more academic, right? In practice, both of the patterns we're discussing, break above 7,600 is pretty bullish, and we probably want to be positioned on the long side if that happens. So that's how I would think of it. I don't mind your suggestion that maybe we label it an ascending triangle. I get it. I guess for me, it ends up not mattering a ton. I guess the difference is what a breakdown would look like, right? Because you would basically, if you're seeing it as an ascending triangle, we could probably break down out of your pattern quicker than we would break out of mine. Looking at a level of support. So something to think about. But yeah, I'm happy still calling it a basing pattern. And I guess the reason is because there's so many times when we just have these big swings below support. And so I think of it as more of a range than as a specific line, I guess. Great question, though. Next question. Dave, what are your thoughts on time cycles and cycle analysis? Yeah, I'm not a big cycle guy, to be honest with you. If you listen to the Market Misbehavior podcast, I love to ask, particularly my technical analysis friends, my peers in the industry, when I have, because I have a number of different types of people on the podcast. Some are more, some are fund managers that never look at charts. Some are financial advisors that may or may not use technical analysis. Some are technical analysts, like John Clovis, right, who's on the show not too long ago, career technical analyst and knows the space particularly well. But I love to ask particularly my technical peers, what do you think about cycles? And I would say there are some people I follow and that I've worked with that do a fantastic job with cycles, I think. Larry Williams probably comes to mind as sort of the best kind of cycle expert, notable cycle expert that I've worked with. Yeah, he thinks of cycles, very heavily. It's a big part of his process. I guess for me, I don't really think of time cycles too often, only because I'm more of a trend-based analyst. So if a cycle comes due, if the trend still looks good or the trend still looks bad, I'm not going to change my position just because we hit some date. I'm going to wait for the chart to tell me that the turn has happened. And if that means I miss a little bit, I think that's a small price to pay for making sure that I'm following the right trend. Others and there are GAN practitioners that I follow that are big into cycles. GAN is a big part about numerical dates and that there are particular dates when things should happen. I'm just not a big buyer into that structure, and it just has never been a big part of what I've done. And probably the reason why is, again, working for large money managers for a number of years, you just can't use cycles too much, right? Because if you own a bunch of stocks that are doing well And just because a cycle comes due, you can't sell those, right? If they're working for you, you want to hold them as long as possible. And you want to show your clients that you're holding them to reinforce your process. So it just hasn't been a big part of it. But again, there are plenty of things under the technical umbrella that I don't use, right? I don't use every indicator out there. I arguably use very few, as I think you have to minimize the noise and have meaningful signals. Having said that, the way that I kind of correct for that is cycles are interesting to me. So I love talking with Larry Williams occasionally and seeing what cycles come due. I have GAN analysts that I love connecting with and saying, hey, what are you seeing right now? And I read a lot of stuff that comes across emails and research. And if I see something that's interesting, I'll reach out to them and say, hey, can you tell me more about this cycle? Like, what does that mean that it's coming due right now? There's a group called the Foundation for the Study of Cycles that is really devoted to this. It's launched many years ago by Edward Dewey, who's sort of like the grandfather of cycle analysis, and a lot of modern practitioners like Larry Williams and others that think about cycles. It's just not a big part of my process, but I respect people that use them. And my solution is don't look at them often, but talk to people that do. I'm a big believer in circling back with people that use cycles and GAN and Elliott wave and other things that I'm never going to use in my own process. See how their insights compare to my own. Final question. Could you give some insight on possible entry points for Take-Two, ticker TTWO? I love this. A young kid emailed me today to ask about it due to an upcoming new product release that all his friends are excited for. So I love your question because this reminds me of sort of like the Peter Lynch methodology, right? Peter Lynch famously would take his kids to the mall, his daughter, if I remember right, take them to the mall, just ask them about what stores they liked. I mean, it's pretty dated, thing now because malls aren't really much of a thing anymore in most parts of the U.S. But at one time, malls were, a central part of our society, and certainly for young kids and teens. And so he would take them to the mall, just see what stores they like, what products they like, look at the prices, and just use that as anecdotal evidence. But he would never buy a stock in a company just because the kids were at Abercrombie and Fitch. He would dig deeper into the story. Say, all right, they really liked Abercrombie and Fitch or whatever it was. All right, let me dig into that company and see whether it's a good place for me to park some capital. Let's see if it's a good, company that I want to be a part owner of. And so I think in your question, I love how, we hear about companies and tickers from all sorts of things, whether it's a, sort of the cocktail party conversation, it's your Uber driver, it's your uncle, it's a young kid that emails you. Don't have that be the end of your process. Have that be the beginning of your process, right? Take that idea and then vet it. And I think that's what successful investors do is they're happy taking ideas from anywhere, but you don't just blindly buy and sell what someone else says. I don't want to buy someone else's process. I want to buy results of my own process. So that was a sort of first take on what I think you're doing pretty well there. So the question is Take-Two and thinking about potential entry points. Yeah. So here's the thing, right? So let's do a pretty good analysis. First, let's start with a weekly chart. And I would say on the weekly chart, what's interesting is so far coming off the March low, it's been a pretty good, sort of improvement in Take-Two. Take-Two was down around 190 in February and again in March, but it's circled back all the way to retest previous all-time highs from the fourth quarter of 2025, right around 260, right? So just last week, we got back up to 260 again. So I would say that the performance in the last 6 months has been pretty good. The weekly MACD is bullish, but we are testing a major resistance level. So for me, I'd probably be, and that's the same level, I'd probably be a little hesitant until and unless we can make a breakout. So if I'm buying anything down here, I think of it as more of a trade. If and when it would break above 260, that's when I would think of it as more of an investment, right? Difference between buying a short-term swing because of short-term weakness versus taking a meaningful long-term position because you think it's a long-term idea. For me, now that we've gotten back up there and failed, I think a break above 260 and a follow-through would be really, for me, make it a pretty compelling chart. Certainly the weekly chart would look a lot better. In the short term, after testing those previous highs, we've now pulled back right down to the 50-day and the 200-day moving averages, which are right around that same place. I would also, in this sort of environment, probably use Fibonacci retracements. So here we can see that we're right around this 38.2% level. You can see, right, we're kind of testing there today. So, have we pulled back to a pretty clear potential level of support? I would say, yeah. So as a short-term play, I think it would be a great approach to sort of use this combination of Fibonacci retracements, moving average support, all coalescing around the same level. This could be a pretty reasonable place that we have a decent bounce. But again, for me, I would think of that as more of a trade versus an investment, right? For as a short-term play versus more of a long-term play. And again, the weekly chart is where we can think more about the long-term structure. And I think breaking to new highs, exiting out of that weekly pattern, that basing pattern on the weekly chart, for me, that's what I would need to see to get really optimistic for further gains. Folks, that'll do it. Thanks so much for those awesome questions. All 6 of those came from viewers like you over the last week, taking a moment to share questions during our live stream or posting them on our YouTube channel with the comments there. Please keep them coming. It's awesome to hear from you. I appreciate your support. Hope to see you next week at our webcast. You can sign up there at marketmisbehavior.com/coffee. Otherwise, have a fantastic weekend. We're set to travel back to Seattle on Sunday, planning a normal show live back on Monday at 5 p.m. Eastern, 2 p.m. Pacific. In the meantime, have a joyful weekend. And remember, it's always a good time to own good charts. Take care, folks.